back, everyone, to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co-host here alongside Mr. Stephen Thomas, the chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, the recent NAR settlement, the lock-in effect, the recent Federal Reserve meeting, and much more. But first, Stephen, what's going on in the Thomas household?
Well, we're right before spring break. We're about to hit spring break. We have a couple kids off tomorrow. That's right before Easter, and then they have spring break the following week, right after Easter. So we're gonna have lots of kids doing lots of fun things, working and going to the pool and going to the beach and different chauffeuring kids around. So that's what's going on in our neck of the woods. It's just another one of those spring breaks. That's when we're having spring breaks. It's supposed to start off with a bang with rain in the forecast. So rain at first for spring break. So it's not like we don't need the water. It's been a lot of rain lately, but that's what's going on for us. How about you? What is going on in Brennan's life?
Well, I'm just going to start with the short and sweet part. I have soccer coming back this weekend, so it'll already be in the past by the time this is released. However, I have been looking forward to this for weeks because we've been on a break. So it's been very difficult for me each weekend to not have the same sort of fixation on just the club level soccer. But we have had international games, which is cool. But in larger news, I don't know if many can tell if you're watching on the video, but if you're just listening in on Spotify or Apple Podcasts, I actually moved this past weekend. It was all very sudden and in the moment. It's like it happened within one day, and it was just a whole lot of chaos, and we're finally getting unpacked, and it's starting to feel like a home versus a dump. So it's very refreshing. I love it so much. It's not far from like my old place. It's very relaxing, and I love just being here. So
who do you live with?
Moved in with my other brother, Bryce, which some of you have may have heard of, and our cousin Liero. So there's now four of us because I was with Kyler before, and he's still living with us. So it's a big family house, is what you can say, I guess.
3 brothers and a cousin. How fun.
Yeah. Lots to look forward to. But Stephen, as usual, what's going on in the real estate world with supply, demand, and our very own expected market time?
Well, interest rates, interestingly enough, have been they haven't really changed much. Not a lot of volatility. We had big announcement last week. We'll get into that with the Fed, but since then, interest rates have kind of just been flat, but flat under 7% with no points. That's actually really good because the psychological barrier is 7% and above. Anything that has a 7 on it just scares away homeowners from listing their homes because they have to turn around a lot of these people and purchase something, and also buyers from buying. So it just affects both supply and demand side of the equation. So what we're interestingly enough seeing is that the inventory is either going flat or in some markets actually going down a little bit over these last couple of weeks, and demand has been rising. So at this point, we're at the end of March, and the market's actually heating up a lot more so than where we were in prior years, because typically we've been getting the hottest point in the market the start of March, and here we are at the end of March when we're of course recording this, and it's really busy. So that lines us up until tomorrow's another big data point. We'll see what happens then.
So would you say, are we seeing a typical spring market right now?
Yeah, we are kind of seeing that typical spring market. Actually, it's not. Let me backtrack. It's kind of now feeling a little bit more like winter again. So we have demand that rises and typically peaks during the springtime, but we're getting it's still continuing to rise. It hasn't peaked, but it kind of like is a prelude to what can happen later on this year. And that is, as interest rates drop more, demand picks up. So we may even get rather than a peak during the springtime, a peak later on during the year as rates come down further and excites a little bit more demand, draws more demand, that we could see that later peak. And then inventory typically starts to climb. We climbed from the beginning of the year till where we are right now, but kind of seeing a slowdown in that in the pickup in inventory. And a lot of people are going to blame it on Easter weekend and things like that. That's not what's happening. What we're kind of really reading, and that'll be part of the part of the tale of the tape. But what we're really seeing, and I've been watching over the last couple of weeks, is not a lot of movement higher in inventory because we've had a pickup in demand. So those homes that would be staying on the market are going into pending sales status. So the active inventory is remaining the same or going down a little bit, which is not atypical for a start of spring. We should already see the inventory going up at a faster clip. So that's kind of where we are right now in the moment. We'll have to see with future numbers where we're going to go from here with future data coming and where interest rates go.
So recently we had a Federal Reserve meeting where they actually talked about at the press conference. Would you mind explaining what happened?
Yeah, so that is one of the big, that was huge. I was actually presenting at I can't remember where I was presenting, but I was in the middle of a presentation when I told everybody, right now the Fed is speaking and they're going to tell us what the path is for rates. And it's very important because they do this every quarter. They do, okay, where's the pathway of rates? Where's it going? They project where it will be for this year, for next year, and the year after that, like as if they know. But so what it took was that in September, they called for one rate cut for 2024. In December, it was 3. And then everybody had thought that all of a sudden that the data should start really materially going down and showing a slowing, and it wasn't, so that they're going to do only 2 rate cuts for 2024. That was the projection for many economists. But my feeling has always been that they're not going to see it in the numbers, but you're going to see it a little bit in the numbers, but it's going to come more later on this year, spring on. So it did not happen during the winter. They kind of concurred. It only took 2 Fed presidents. If they would have said, only 2 rate cuts, if they would have changed their minds, it would have moved it so that we would have only had 2 rate cuts. But last week, what was orchestrated with all the different Fed presidents saying where they thought rates should be, each one has a vote. It's still saying 3 rate cuts for 2024. So no real change from December to March. The next time that they project interest rate cuts and interest rates where they're going is not until June. So there's a lot of data points going forward over these next few months. Buys them a lot of time to see where the data is going to go, which is what they would like to see. Now, they didn't change rates at all, but they did. They didn't change it all, but that kind of news in the news conference, it allowed interest rates to remain the same. Actually, they went down for the day a little bit, and that was because there was the 3 rate cuts were still in there, and the Fed speak was still more of the same. So it was a little bit more dovish in tone than the way that they have been. So December was the first time they had a little bit more dovish, which means they're a little softer in tone, versus hawkish, where they're on the prowl. They're going to rip apart the economy until they get inflation under control and they see some changes material in the economy. So they've changed their tune, and it's kind of the same tune where they're a little softer in their language. So that helps out in the markets and all that stuff. So what we saw this week is the week before Easter, when we're recording this, we actually saw rates remain flat, and we saw equities rise quite a bit, hitting new records. So that's kind of what's going on. And interesting enough, the Fed is still saying they're very data dependent. And so tomorrow, so this is Good Friday, if you're keeping track, prior to, it'll be, when you listen to this, it'll be the prior week. But PCE comes out. It's personal consumption expenditures. And PCE is the Fed's favorite gauge on inflation. It's not CPI. As a matter of fact, CPI's shelter piece, they do talk about it a little bit, the Fed, but they don't actually quote that much of the CPI. They quote the PCE, and the PCE is already in the twos core. Remember, they want inflation to be under control at 2. They're already, this thing was way higher, and it's coming down all the way into the twos right now, and will continue to telegraph going lower, but it all depends upon what happens tomorrow morning, 5:30 a.m. PCE comes out. That could really move rates. If that thing is if inflation's even more under control than they had thought, you'll see rates drop further into the 6s. If this thing is too hot and inflation's not coming down, you could see interest rates start to float back up above 7% again. So, and if it comes in just right, we'll see more of this flat line that we saw. So we'll just have to wait and see. 5:30 in the morning, we'll gauge where we're at, and then 6:30 is when the markets open our time. And so then you could see what's happening with the 10-year Treasury. You'll get some pre-market information prior to the markets even opening. And so by 6 o'clock a.m., you should really know where rates should be based upon looking at the 10-year Treasury. And if it's down, that's good news for everybody that's linked to real estate, even those that are buying. If the thing is green and up, that's not good news. So we'll have to wait and see. Tomorrow morning is very important.
Now, recently, there's been a lot of news about the NAR settlement. Now that we've been digesting the settlement for a couple of weeks, can you describe the settlement so far and what possibly can happen?
So there's only really 2 giant changes in this thing, and they're pretty big. One of them is the removal of any kind of talk about commissions to the buyer side of the transaction with an MLS. The second one is all buyers agents have to have their buyers sign an agreement, a contract. And buyers can actually they can say, I'll pay you X or I'll pay you Y, or I'll pay you nothing to come represent me. Now, this has already been taking place. There's an MLS, I can't remember the name of it, that's already in the country that's been doing this since 2022. And what happened with that is, because everybody's saying how there's a lot, New York Times ran another story because sometimes there's a lot of stories out there that are very negative on the real estate industry and that this will bring commissions down. And the thing about papers, and not just papers, but press and all that stuff, they'll put out their PR feelers out, and they're looking specifically for people that will answer the following. What they were looking for are sellers that are paying no money to the buyer side of the transaction. And of course, there's going to be some people, because of all the headlines and all that stuff, that are going to try this out. So it's going to be rocky at first. But what happened with that MLS is it was business as usual. Even though the commissions weren't in there, the seller was still paying the buyer's agent commission. And that can still happen in this settlement. It doesn't mean that they can't pay it. It just means that it can't be in the MLS and everybody needs to know it's negotiable. In the state of California, it's in big, bold print that it's negotiable anyways. And you have to explain all this because there's a giant paragraph where you just can't say, here, sign there. No, you have to read it. It's in big, bold print. And so it is negotiable. And at the end of the day, I think that there's going to be some rocky points at the very beginning where after a while, the market is going to prevail. Normal economics is going to prevail. Now, there are some economists that think that, well, sellers are just going to say, I'm not paying for a commission. Well, if you want your home sold and you want as many eyeballs as you can come through, the way to do that isn't the listing agent take a whole bunch of offers from all these different buyers, because they're going to go to the listing agent direct, because then they have to put together contracts with every single one of them. That sounds awful. So that's not the way that anybody's going to want to do business. They're going to want to do business the way that they've been doing business, and that is expose it to as many buyers as possible that are hooked up with a buyer's agent, where the buyer's agent is working on behalf of their buyer, getting them the best possible terms, and then taking care of the giant the giant enchilada of getting these homes closed. I actually think that in the end, sellers are going to continue to pay for the compensation, buyer's agent's compensation, and it's not going to have to come from the buyers. There might be some that do. And that's still part of negotiations too. If a house is sitting there for a long time, the buyer can actually ask for them to pay the buyer's agent's commission. So there's a whole bunch of different ways that this thing's going to work out. I still think that sellers are going to be continuing to pay it. And another thing that I'm absolutely certain, talked about it in one of my not my podcast, but the housing debrief, is, hey, you know what? Even if they save money and they're paying less in commissions, they are not going to pass that along to buyers. And people say that sellers are greedy. You know what? At the end of the day, sellers are looking out for the best interest of themselves and their families. And so they want to get as many dollars as possible into their bank accounts. And the way to do that is to maximize how much they sell their homes for. And the old system's going to work best. They're going to learn this over time. But even if they're trying to save money, they're not passing that along. There's going to be no deterioration in pricing because of this settlement. Anybody that thinks that this is going to happen doesn't know economics. So it's a simple economics of supply and demand. Right now, there's very little supply. And so sellers get to kind of call the shots. And one of those is going to be, I'm not giving you a discount because we're paying different in commissions or something like that, which I don't think that's what the story is going to be when this thing all irons out in the long run.
So is the settlement something realtors and people part of a real estate transaction should be optimistic or concerned for?
Yeah, I really think that overall, I think we're making it. This is a big change. Just there have been big changes before. One of them is after Dodd-Frank, there was this thing called TRID, and that was all done through after the fiasco of the Great Recession. It changed the way that lenders had to do business. And I remember lenders were going, oh my gosh, this is a total nightmare. We're not going to be able to close things as fast as we did before. There's way too many disclosures and all that stuff. We're going to end up making less. This is going to make the process different. And it didn't. After a while, it kind of worked its way out, and it's still business as usual for them. So can there be some sort of pressure on commissions? There already has been pressure on commissions, and that is in the form of when you have such limited supply, there's pressure on commissions. That's just the way that the market works. If all of a sudden there was nothing selling, this is a really good time for sellers to be doing this because there's very, very little supply. But if you've got a home that is going to be harder to sell and you need to get as many eyeballs through there as possible, you're going to be offering a commission to the buy side no matter what. And I think that's pretty much, like I said, the way that things are going to go. But there could be pressure. So those people that are extremely pessimistic, which I've heard of, is just because of the fear of the unknown. The fear of the unknown, when you worry about it, you make hay about nothing in the end. I think it's 92% of everything you worry about doesn't come to fruition. That's been the study that was done by universities. So we don't really need to worry about the worst case scenario. Don't worry. There's plenty of different media outlets that have taken care of the worst case scenario and have planted it in the brains of so many people, and everybody's running with those kind of stories. But after a while, it's just going to get old, and they're going to find people that are going to say, I paid nothing and all that stuff. But you know what? It's not going to be the true facts, and we're going to know what the true facts are based upon what's really going on in the marketplace. So I don't think it's going to be as ugly as what they're talking about, and it's not going to be exactly the way it was before, but it's going to be definitely in between.
Now, could NAR hypothetically raise their fees annually in result of the settlement?
Not this year. They said they're not going to touch it, but can they? Sure, they absolutely can. But also at the end of the day, they're not going to be making it so that it's impossible for them to do it going forward. So they're not going to double the fees or anything like that, because there will be an exodus somewhat of some agents that won't be able to afford to pay all the different fees in order to belong to the multiple listing service in their local association, as well as the National Association of Realtors. There's a whole bunch of fees. And what people don't understand is that for agents, it's expensive to operate. So, and they don't get paid. They don't have insurance. They don't have, they don't have vacation days. They work a gargantuan amount of hours and do not get paid until something closes. So at the end of the day, you really have to be on your A game, and it only goes to those people that really treat this thing like a profession. And this settlement is only going to clean up the industry even more. So for all those people that say it's so easy to get your license, now you have to actually show your value to the listing side and to the buyer side, articulate it well, help everybody totally understand what's going on, and it's going to make the industry stronger and better in the end. And otherwise, you know what? This is a very complicated process. And there are a countless number of contracts. This is not like it was 25 years ago, 30 years ago, 50 years ago, when there was like a one-page contract. You can write a contract on a napkin. No, these things have been carefully crafted because of all the lawsuits and everything. So there are tons of contracts, tons of print. There's the process is filled with a lot of different contingencies and inspections, and you really want to lean into somebody that knows their stuff. So at the end of the day, you can either you can go with a real estate agent, or you're going to have to go with an attorney that will help navigate you through the process, because even attorneys can be brokers. But I can tell you this, it's not going to be inexpensive to go the attorney route. So there's a lot of justification for a lot of the fees that agents are being paid, and whether you like it or not, they're running a business and they have to pay for themselves. They got to pay for all the different fees that I talked about, the different trade groups and association groups and all that stuff. They've got to pay for printing and marketing and a whole bunch of different things, and they only get paid when something closes.
So, for people in real estate or just looking at real estate in general, what would you recommend looking at or turning to with the changes that are coming to hand?
Yeah, so what would I recommend for the changes that are coming? I would be upping my game, and that is. So I used to represent buyers and sellers a long time ago, like in the 90s. So, and in the early 2000s, and then really went the route of helping out with the brokerage, and then went the route of a housing analyst. So how it all happened is for another podcast. But basically, back in the day, I had a marketing proposal. First, it was called a listing presentation, but then the go-to term for it was marketing proposal. And I also had what I refer to as a buyer's travelogue, and then I called it a buyer's book. And in that, I actually explain everything that we do. And the more that you explain, the more that there's transparency in it, and all people understand, oh, I didn't know it was this complex, until they're actually then signing all the contracts and doing all this stuff. Do they realize this is bigger than what I thought? And anybody that's tried to go for sale by owner, if they got sued, they don't have all the necessary contracts and all that stuff. They could really be damaging themselves, because the only person to go after when it's for sale by owner is who? The seller. So that's who's on the hook for that. So they're leaving themselves wide open, exposed. It's way too complex of a process to try to do any of this stuff on your own. I mean, you could definitely try, but I would seek out the blessing of some sort of attorney to back it up if I was going that direction, which, once again, now you're paying what is considered somewhat of a commission, because you're now paying for attorney fees. So it's a very, very complex process. And when you explain it, full transparency, what your value is as a buyer's agent, as a seller's agent, and then articulate that. And that's what the industry is going to have to do. Like I said, it's a really good thing for the industry, because it's going to get rid of the idea that anybody can do it. It's super duper easy. Sure, everybody thinks it's super duper easy when it's really easy. But when it's harder, like it's been right now, where it's been slim pickings, only the strongest have been able to survive. There are a bunch of agents that have done nothing or one transaction. You can't live off of one transaction. So, and it's what this is going to do. It's going to make you buyers and sellers alike. They're all going to go towards the absolute professional, the one that's treating it like a profession. And it's just going to make it a lot stronger. Now in the movies, you're going to see a sophisticated actor that's going to have to play the role of a real estate agent, because that used to be the standard role of, hey, what role should they, what should there be their profession? We got to make one up. And they'd say, okay, real estate agent. You see them holding open house signs and for sale signs, and oh, I just closed a transaction. It's just not that easy. So instead, they shouldn't even be in the picture because they're working until 10 o'clock, 11 o'clock at night, and sacrificing time with their families so that they can get things done. So that's what's going to evolve.
So, an interesting question I have for you is, can technology and the result of this lawsuit cause the real estate industry to go to the way of the travel industry, how it's all made very independently with very few people using travel agencies, which for some reason is almost unheard of for my generation?
Yeah. So travel agencies were keen before the internet. And I remember when they went away, everybody's saying that's what's going to happen with the real estate. And since that time, that was right around 2000, that we saw the travel agencies just disappear. I mean, there's a little bit of that that's left, but there's everything. Any maps, you can get that online. You can get maps on your phone. You've got mapping capabilities. You can get a bird's eye of the whole entire thing. You can go on the net and find yourself a hotel, a car. You want to do some other things? Oh my gosh, they throw this at you. They throw that at you. You're going to Cancun. Here's what this is. You should try this. You should try this zip line. And all that. So much coming at you. Yeah, definitely. I totally understood why it was going away. And I remember the big argument that the people were making that said, yeah, real estate industry is next. And I go, there's just no way. This is not going to some hotel and traveling on vacation and spending a few $1,000s. This is buying now $1 million house here in Southern California, or a $500,000 house for the rest of the country. That's a big, giant ask. And if you're going to do something like that, you want all the proper protections, all the proper contracts. You want somebody that's able to navigate the whole entire process, which if you look at the matrix of how it looks, which I did it on that video that we put together for the housing debrief, it is a complicated process. And when you deal with a professional, they're able to just ease you right in, explain the whole entire thing, and the process is smooth. And that is the way that it's going to go. We're going to instead have even more professional agents that will trickle up, burp up, where they say it's like 10% of the agent population does 90% of the business, but it's slowly but surely that needle has been moving to 5% doing 95% of the business. That's the way that it's going, and this is what this kind of a settlement is going to do. It's just going to make it an even more professional atmosphere. And shoot, I remember buying my first house, and good thing that I was like a third generation broker. I had people to talk to, but I was like freaked out of my mind when I bought my first house, and there were so many contracts, and it was just, my head was spinning. But of course, I was able to talk to some people that have been doing it for a really long time, and one being my dad, one being my grandma and grandpa, and they were able to ease my way through the whole entire process. And that is the life of a real estate, and the reason that real estate industry exists is to make that complicated process of real estate purchasing and selling as easy and simple and understandable as possible.
So, changing the tune, the president of the National Association of Realtors, Kevin Sears, following the current presidential administration's housing plan, which we talked about recently, he said that real estate agent commissions are driven by the market and are not the cause of the affordability crisis. Until there is an all-of-government approach to a historic lack of inventory and supply in communities across the country, the dream of home ownership will remain out of reach for millions of middle-class Americans. Is this something you particularly agree with?
This is also has a lot to do with the Great Recession, what came out of it, because we were building and building and building like crazy, and a lot of builders got burned. And from that became the builders that remained were the strongest, and then they were traded on Wall Street, and now they answer to Wall Street. So at the end of the day, they're not going to answer to what is good for and best for the country. They're going to answer to what is good and best for their stock. And so that means profitability is keen, doing all the right things is keen. And so we need to pave the way to allow, and he's absolutely right. Paying commissions isn't the problem. The problem is we haven't built enough homes. Baby boomers are aging in place and not moving like so many people had thought. That demographic has not moved. And then the millennials are the biggest demographic patch of first-time home buyers. We've been dealing that with several years, and it continues to this day. And they've been underserved and they've been unable to buy. So as a result, they're having an issue buying. By the way, this happened also in 1981 to the baby boomers when they were the age of millennials, first-time home buyers. They were unable. I think you forwarded me an article about that. That was on X, formerly Twitter. There was documentation that shows that they really they struggled to find a house, and it sounds like millennials. So we have this perfect storm of a lot of things happening all at the same time. So we have depleted inventory, not enough building, and we have this big demographic patch coming, and now we have these rates that are higher. So it's like, oh my gosh, as everything is stacked up against this real estate market. It's not commissions that caused it. Inflation caused it. Higher interest rates caused it. It's lack of home building that caused it. So now, instead of pointing fingers at all these different industries, let's look to see what the real problem is, and that is not enough building. And how do you rectify this? It's not by saying, here, you know what, we're going to give you a big giant bonus builder if you build this lower income stuff, because they're not taking it. Why are they not taking that? Because at the end of the day, it's still too expensive to build a home, and it's all the different fees and all the red tape and all that. That's what they need to work on. They need to work on the fact that it is expensive to build. It is expensive just to even put the first scoop of dirt in, put your shovel into the dirt. It's expensive. And it's because of all the different fees and the red tape. That's what we need to work on. Diminishing those fees, diminishing how long it even takes to start building, and make it a little bit easier so that everybody can understand that, hey, you know what, this can be a better process. All the builders will then, they can then build. And then after you've gotten rid of all the red tape, then incentivize them to build towards the entry level housing. There's many different facets. And the beautiful thing about this is not a red or blue problem. This is it's not one or the other. It's both. It affects everybody, period. And they need to get out of their own way and figure out how to deal with this. As soon as we can get government to actually talk to each other, maybe we can come up with a solution and start working on the supply side of the equation, which is broken. And there's other things too that they can do. There's capital gains exclusions. There's being able to port your existing mortgage and move it to another property. There's a whole bunch of things we could do to make things to make this housing market move again. And unfortunately, they're not addressing it at all. What most of this program was more about was not really incentivizing the supply side. It's talking about the buy side, the demand side. We already have plenty of demand. We need to fix the supply side so that there are more homes in the marketplace, so that we don't have values that can continuously climb, and we'll have fewer and fewer people that can afford to purchase because there's a limited supply. So that's really, in a nutshell, what I think, and I think that that's kind of what Kevin Sears is alluding to in that.
Now, earlier you were talking about interest rates and how there's a different sort of psychology when you're saying a 7% versus like a 6.9 or a 6.8. So is it safe to say the lock-in effect or golden handcuffs had eased when rates dipped below 7%? It was said that the Federal Housing Finance Agency believes the mortgage rate lock-in effect could last for years if rates do not drop.
Well, I'd be really surprised if the economy continued to churn at its current pace when we have some major headwinds coming our way, where we have savings rates are at lows that we haven't seen since 2009. Credit card debt is ballooning. The credit card delinquencies and automobile delinquencies are ballooning. The excess savings that citizens have had across the United States, that is set to to be gone. So they're running through all their excess savings probably by the at least the midpoint of this year. You can put all that together, and it's just a recipe for things to slow down, not to go into recession, but not to be the same pitch that it's been all along. So those people that think it could be rosy and sunny and blue skies all the time, I remember hearing that prior to the Great Recession. That doesn't mean we're having a Great Recession that's coming up. What that means is that it's not always blue skies and sunshine and roses and flowers and all that all the time.
The Redfin CEO said that the Fed's inflation fight will affect the housing supply for decades to come. So, Stephen, how long do you believe the rate hikes and battle against their dual mandate will affect the housing market for?
Well, that's a bit snarky. Uh, that'll affect it for decades, or yes. I don't quite buy it because I'm already seeing rates haven't really materially come down year over year, but we're getting more homeowners that are placing their homes on the market than they did last year. So we were at this low threshold, and all of a sudden we have more homes coming on the market than last year, and we don't have lower interest rates. They're actually a little bit higher than they were a year ago. So that shows that the longer this goes on, that the more that homeowners will be more inclined to sell regardless of what their rate is. And the anticipation, like I said, is rates are supposed to come down, which will narrow the gap between what so many homeowners are locked in, that locked in effect, to where the prevailing rate is of the day. And you also have to understand that the interest rates are artificially about 1% higher than they should be. So those will, and once all this uncertainty is gone, we get inflation genie back in the bottle, which people say it's impossible to get the genie back in the bottle. It does take a long time, but we're getting there. And you get the inflation under control. And once the Fed starts actually cutting rates, you're going to see that rates start to fall. And then you're going to see that where interest rates should be, or nothing can happen in the market other than uncertainty starts to wane, and then we're going to see rates continue to fall. I anticipate that in sometime in 2025 or 2026, I can make an easy case for interest rates to get into the fours. So, and we'll have to talk about that later on down the road, but there is a definite, we should be in the fives. And if we have the economy cool, you can watch interest rates float down about 0.75% where we're at right now. It could be an exaggeration because we were at 8 back in October. We got down to 6.5 at the end of December, and we're at right below 7 right now. I can see it go down to 6 and then come up to 6.5, but then later on get into the fives. And then as that discrepancy shrinks and where rates should be, I could see that argument of it getting closer to the fours. So that's what I see. I'm not as pessimistic as the CEO of Redfin.
So Dallas Tanner, a chief executive of Innovation Homes, stated that tricky local regulation and a decade of cheap money in the housing market has created a perfect storm for prices to stay high. So Steve, would you say there are more factors at play, or that the two factors that he discussed are mainly to blame for today's prevalent issue?
Yeah, really, today's issue is underbuilding. So you could actually see it. You could see it drive down all the way to prior to COVID. You could see it at January of 2020, the inventory is at its lowest point going back to when National Association of Realtors tracked the inventory in 1982. So already had a major problem, and that was because we weren't building. That lost decade of not building. Like we were building prior to the Great Recession. Afterwards, not a lot of building going on. Very, very few sticks. And that was a real issue. And then the rate hike, so the regulations were all part of that. But then keeping money cheap for too long was another contributing factor. So after the Great Recession, every time they played around and they went down to zero, then they would go up a little bit, and then they would unwind that, bring it back down towards zero again. It just created easy money and all that stuff. So yes, the argument for, and now you can look back at it so that later on down the road that they don't do this kind of thing where they keep it down at zero for too long. They did the same thing in result of COVID. By the time we got to 2021, the summer, you could see in the numbers that, we have an issue here, that they need to come off of zero and start to raise the rates. Well, they waited all the way from the summer till March of 2022, the spring of 2022. So skip the autumn, skip the winter, wait until spring, waited too long, and they kept it at zero for too long before they made their move. So they can too learn from that, because that's what economics is all about, learning from your past mistakes. And that's what they can do going forward. So we can look at it and say, yes, that is what's absolutely contributing to it. Let's learn from it, not make this happen again down the road.
Well, thank you everyone again for tuning into another episode of Let's Talk Housing. If you want to learn more about what is going on in the real estate industry across Southern California or the Bay Area, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. And if you have any questions at all, feel free to leave a question in any of our comments or our social media, or you can shoot me an email at info@reportsonhousing.com. We will see you soon and have a fantastic rest of your day. Thank you.
Thank you.